How to make 40% on your initial investment. Before we even get started, if you're one of those people trying to get rich quick, you think, great, I can make 40% my first year, just click off this video. It's not a get rich quick thing, hate to break it to you, but it actually does take time. So again, just click off this video. This video isn't for you. Go look up how to day trade penny stocks or something. All right, so for those of you who actually know it's gonna take time, yes, it is possible to make 40, 50, 60, even more percent a year off your initial investment. And that's with these two little terms with dividend stocks. One of them is yield on cost. And then another important thing to look out is payout ratio. All right, so what's yield on cost and payout ratio? Yield on cost is a measure of a dividend yield calculated by dividing a stock's current dividend by the initial price paid for that stock. So pretty much what that means is, say you have $100, you buy into a stock and it's paying say 4% dividend, you're making that $4. But then what happens next year when the stock goes up? Say it goes up to $200 and say there is dividend growth. That's kind of why you want to invest in dividends, because that dividend should grow with you. So maybe it was paying you that $4 a year, and now this year it's paying you $5 a year. And then let's say it keeps on going up year after year after year. Well, eventually you're going to hit a point where maybe that dividend, maybe that stock is paying you $10, $20, $30 off your initial investment, and your investment was only $100. There's that 20, there's that 30%. So that might be a little confusing if you're not following along with what I'm saying. So let's jump over to, you already know, Seeking Alpha. And we're gonna look at TD, Toronto Bank. It has had a great dividend yield. And this is really going to be so you could better understand yield on cost. So if we look at the computer, here's Toronto Bank, and you can see its dividend yield is 5.72%, a little on the high side, but that's okay right now. We're not going to worry too much about that. Right here, that 5-year dividend growth rate, it's been growing at around 7.9% a year. So what does that mean for you? Well, if we go over here to yield on cost and click on that, here you go. This will show you what your yield on cost, how much money you are making from your initial investment in TD. So this is 5 years. So it doesn't seem like too much is happening right here, but you know, you got to let time come into play. That's why this isn't get rich quick, right? You want to be like Warren Buffett. He has billions and billions of dollars, but he's 89 years old. It took him decades. We go back 10 years, you can see a pattern here, it's growing. 20 years, it's growing. All time, there you go, look, there's that 40%. So exactly what does this chart mean? What are we exactly looking at? It's really simple. So if we go back, this is how many years on the bottom, right? You see 0 all the way up to 23 years. This is how many years you need to be invested into this company to have this return. If you bought TD, say a year ago, you're making 4% on your investment. If it's $100, you're making $4. What if you continue to hold on to it, right? And it'll kind of show you, what if you bought it 3 years ago? You're getting a bigger return than the person that bought it last year. What about 10 years ago? Now we're at that 5.8%, we're coming close to 6%. Let's fast forward a little bit. 15 years ago, you're at 10%. Keep on fast forwarding, go to 20 years, we're up to 18% on our initial investment. And if we go all the way, let's say you bought in 23, 24 years ago, yeah, you're making 40% on your initial investment. So to really just sum that up, you have $100, you invested it in TD, and you've held on to that stock for 20 plus years, say 23 to 24 years, that $100 initial investment is now making you $44 a year. That 44% a year. And you may think, great, I gotta wait 24 years for that. But you gotta think big picture. What if you're someone that has maybe a couple tens of thousands of dollars or hundreds of thousands of dollars? Imagine you want to retire in 20-something years and you want to live off dividends. Here's how it works. Here's how people do it. They buy into great dividend growth companies like TD. I'd say this is a pretty good dividend growth company. At least it has been in the past. We don't know about the future because no one could predict that. But if you put in, say you have $100,000, you put this in back in 1996, you're now making $44,000 a year off that initial $100,000 investment. Things starting to click. And one thing you got to realize is it's not as easy as it sounds. It doesn't mean whatever company, whatever dividend growth company you're going to buy into, it's just a waiting game. You actually have to pick dividend growth companies that will produce that. Not every company is created equal, and not every company will be as successful for you as a dividend and growth investor as TD if it was 1996. Here's what I mean. If we look at Disney, right? Everyone loves Disney. Everyone knows, oh, Disney is a great dividend stock, but we go back that same 23, 24 year mark, right back to 1996. You could see in this chart right here, you invested, say, $100,000 back in 1996. You're only making 8% 24 years later. In fact, you were making more money several years before that. It has gone down. And that's just because of the way the price fluctuates and all of that other stuff that we're not going to get into just for the sake of the video's time. But not all stocks are going to be created equal. So you need to really find these great stocks that will continue to go up over time. You may think that, oh, Disney's a great stock, but you can see right here, if your strategy was to make that 30-40% a couple decades from now, right now Disney's not producing that for you. It was doing better back then. Back in 2015, you had some peaks, and then for a while it was choppy. It wasn't as high. So because of that, maybe it wasn't producing as much money. Maybe it wasn't paying as much. There's a whole bunch of different variables that you need to look into. But that's going to lead us into our next question, our next term, and that is payout ratio. Payout ratio is very important to look at. And for those of you who don't know what payout ratio is, it's got to be one of the easiest terms to define. When a company who pays dividends has their earnings at the end of the year, whatever it is, let's say it's $1 billion. They made $1 billion for the company. That's earnings, not revenue, right? Their profit is $1 billion and their payout ratio is 30%. Out of that $1 billion, they're paying out $300 million to its shareholders. What is it doing with that other $700 million? Paying off debt, maybe reinvesting into the company, research and development, acquisitions, whatever it might be. So when you're looking in payout ratio and you want to buy into a company now that will maybe make you a lot of money in the future, 20, 30 years down the road, you need to look at payout ratio. That's very important. And here's where you find payout ratio on Seeking Alpha. You really don't see anything that says payout ratio here. That's because it's in dividend safety. And this is what you want to look at. So this is for TD. Its payout ratio is 60%. So if it is making whatever it might be, if it is making $1 billion a year, they are paying out $600 million. But it doesn't always stay the same. That's just what it is right now. If we look back in time, we go through, it looks like we can only go back several years for this, but you could see it's been hovering around that, 45% to 42. It's been bouncing around the 40s. So you could see that with TD. If we go to, say, an older stock, how about AT&T? If we take a look at its payout ratio, you could see its payout ratio was much higher. It was in the 70s, and that's something that really can't be sustained if they want to continue to grow. Because you gotta remember, for every dollar they're paying their investors, it's not going back into the company. It's not growing. So that's why you don't want a super high payout ratio if you're thinking long term. If you're thinking 10, 20, 30, even 40 years, how is the stock going to sustain its dividend growth if it's paying out all of its money? So here's a really good example. Apple, one of the biggest companies in the world, and it's starting to pay out dividends. You can see its payout ratio is 26%. You may think, oh, well, its dividend yield's only 1%. Why would I want to invest in that? Well, you got to think, it is growing at a 5-year rate of 10% a year. So that 1% is significantly growing. On top of that, this stock is just, it's Apple. Any time that you've invested in it, before 2019, you're making money. If you invested it 10 years ago, you'd have a decent amount of money. So for the fact that it is starting to pay out dividends, and even though its dividend is very low right now, that's okay, because you got to think, where will it be in 10, 20, 30 years? Maybe that 1% will be 2, 3, or 4%, but that yield on cost will significantly go up. If you invested in Apple 20 years ago, you already have a lot of money. We all know that. But look at this. It'd be paying you, before the crash, it'd be paying you 260%, 300% on your initial investment. So if you were lucky enough to put $100,000 into Apple 20 years ago, you were being paid $300,000 a year from that initial $100,000 investment. So now you know yield on cost and payout ratio. You know where to find them on Seeking Alpha. Play around with it. Figure out, which stocks you think will be these strong dividend growth stocks for the next 10 or 20 years. What's your plan? What's your strategy? That's all I got for now. See you in the next video.